Hey guys, in today's video, we're going to talk about one of the most fundamental concepts in trading, supply and demand. We'll explain what they are, how they affect the price, how to mark them correctly on the chart, and the psychology behind why price reacts to these zones. By the end of this video, you'll know how to mark strong supply and demand zones, how to filter out weak ones, and how to trade them with higher accuracy. So if that's something you're interested in, hit the like button to support the channel and subscribe if you're new. Let's begin with the basics. In trading, every price movement is driven by one simple force, the balance between buyers and sellers. When demand is higher than supply, price goes up, because buyers are forced to accept higher prices. On the contrary, when supply is higher than demand, price goes down, because sellers are forced to accept lower prices. Now, if we apply a volume footprint to the candles, we can see this process more clearly. The volume footprint shows how much buying and selling happened at each price level inside the candle. If buyers are more aggressive, we will see more volume on the buying side, meaning traders were willing to buy at higher prices. If sellers are more aggressive, more volume appears on the selling side, showing that traders were willing to sell at lower prices. In simple terms, price moves up when buyers are willing to pay higher prices, and moves down when sellers are willing to accept lower prices. This is how all price movement happens in the market. Now, what are the supply and demand zones on the chart? A demand zone is an area where buyers previously entered the market and pushed price higher. Similarly, a supply zone is an area where sellers have entered the market and pushed price lower. These zones are important because markets often remember where strong buying or selling occurred. When price returns to a supply zone, sellers may step in again, potentially causing price to move lower. When price revisits a demand zone, buyers may become active again, which can push the price higher. In simple terms, demand zones act like potential support, and supply zones act like potential resistance. They help us identify areas on the chart where price is more likely to react rather than move randomly. But the key point here is that we want to look for aggressive buying and selling when identifying supply and demand, not slow, sideways movement. Strong zones are usually created by impulsive price moves, showing clear imbalance between buyers and sellers. To make things more objective, we need to see 3 green momentum candles to mark an area as a demand zone. Similarly, 3 consecutive red candles with large bodies and strong push distance would make a good supply zone. The reason is that we want to identify an area where traders previously showed interest, rather than just small moves in the market. Now, how do we correctly mark the supply and demand zone range on the chart? While traders use different methods to mark these zones, the most important rule is to focus on the area where the move began. Marking the start of the move largely depends on the candle's formation. So, let's look at some common ways to mark these zones on the chart. Here, this is our latest impulsive move to the upside. This green candle represents the area that created this move, so we mark it as the demand zone because we believe the decisions were made during this candle. When price returns to this area, we expect a rejection somewhere inside this zone. Another common way is to mark the last red candle before the bullish move. This candle represents the last selling pressure in the market. We mark this area as a demand zone because once price breaks above supply, it turns into demand. When price returns to this area, we expect a reaction, which may lead to a rejection or continuation to the upside. Now, in this particular example, it does not matter which candle to choose because they are about the same area. However, in some cases, the candlestick formation defines which area is better to choose. For example, if we mark the first red candle as the beginning of the bearish move, we would end up with a very small zone, which is probably not a good way to identify supply. In this case, marking the last green candle gives us a more valid area. On the contrary, in other situations, the first red candle may provide a clearer and more reliable supply zone, depending on how the move develops and how price reacts afterward. Another important concept is the wick. Here, the demand zone is drawn from the wick of the candle, since it shows where price was rejected and the momentum move began. The move did not start from the first green candle, nor the previous red candle. It started at the bottom of the wick, which forms our demand zone. Wicks are important price action signals on the chart because they highlight areas where strong price rejection occurred. By marking these levels, we can often expect price to react again when it revisits the zone. With all that being said, here's a very important point. No matter how accurately you draw the supply and demand zone, getting rejected exactly from that zone is not guaranteed. Sometimes the market reverses before reaching the demand area, and other times it needs a deeper retracement. So, how do we avoid missing trades and stop-loss hunts? To reduce the chance of missing trades, you can place your entry a spread size above the start of the demand zone. This way, price can trigger your buy limit, even if it only taps the tip of the demand zone before rejecting. To avoid stop-loss hunts, you can give your stop a bit more room when dealing with a small demand zone. In the case of a larger demand zone, consider entering near the middle of the zone and placing your stop-loss below it. Up to this point in the video, we've talked about what supply and demand zones are, the psychology behind them, and how to correctly mark them on the chart. And now we're finally moving into the important part, how to actually trade them.